Good morning and welcome to the Open here on BNN Bloomberg. I'm Roger Peterson in for Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Canadian home sales rose slightly for the third straight month in June. The number of sales increased by 0.5%, building slightly on the previous 2 months. The Canadian Real Estate Association now expects, though, a decline in yearly sales compared to 2025 and has lowered its guidance for the year. However, the group says slight gains over the past 3 months suggest a recovery in the market is taking place. Manufacturing sales in Canada reached a record high in May. Sales rose 1.3% to $78 billion, making it the fourth consecutive monthly increase. 14 of the 21 subsectors saw increases, led by the transportation, equipment, and chemical subsectors. The largest decline was seen in the electrical equipment and appliance subsector. Canfor is permanently closing its pulp mill in Prince George, British Columbia. The Northwood closure will result in an annual reduction of about 300,000 tons of pulp production. The sector has been hit with shifts in the global market, creating an oversupply and a decrease in pulp prices, resulting in financial losses for the company. About 300 employees are impacted by the closure. And turning to the markets right now, even with what's unfolding in the Middle East, the Dow and the Nasdaq and S&P 500 all in a little bit of a rally right now. Nasdaq up by 0.63, S&P 500 by 0.26. Looking at the TSX, from yesterday, it pushed up close to a record high from set about a month ago. Still a little shy of it, but materials was pulling the market up yesterday, going the other way. Communications off by about 1.57. Let's take a look at oil now, see where it stands. And WTI, it's up about a half point, but still below 80 a barrel. Not really facing as much pressure maybe as expected with the renewed attacks on Iran by the U.S. It is up, of course, over the last few days, but nowhere near the highs that we saw in March, April, and May. Gold. It is rallying slightly, pushing towards 4,100. It turned around after a drop earlier, but up now at 0.15% at 4,076. And taking a look at the loonie, it is up ever so slightly at 71.17. Now, the loonie has been seeing some strength recently after the U.S. released cooler than expected inflation data, making it less likely that the Fed would hike interest rates. All eyes will be on the Bank of Canada's rate decision today as investors wait to see how the central bank is balancing a weak economy with inflation heating up. Joining us now is Rahim Madhavji, president at Knightsbridge Foreign Exchange. Rahim, thanks very much for joining us.
Thanks for having me.
Okay, what kind of an impact do we expect on the loonie with the likelihood that they're going to stand pat, the bank?
Well, I think for the most part, the Bank of Canada is going to stand pat. But really what we're looking at is what are the revised forecasts going to look like and what is going to be the tone of the presser. So the Bank of Canada has really come out recently with 1 foot on the gas and 1 foot on the brake. And it's not really sure. It's trying to be nimble and trying to decide what it's going to do in the future. On one hand, we've got creeping inflation that's causing a threat and a potential problem. And we've got a weak domestic economy. And those two things are counterbalancing each other. So everything's going to come down to the tone of the presser and basically what the revised forecasts are going to be. We still expect them to indicate that they're going to be nimble. I don't think a lot has changed from the last press conference and some of the other comments that they've made recently. So we expect more of the same, expect them to be nimble and to kind of look in both directions before the data guides them as to what to do.
Okay, and when you say nimble, what are they going to be looking for, and what does nimble mean to you?
Sure. So, on one hand, they've got to be able to predict what is going to happen with inflation. And so, while inflation has probably been, a little bit higher than what they'd like, it's not that much of a concern where it's pushing them in a direction to combat that with higher interest rates. On the other hand, you've got, Kuzma, you've got tariffs, you've got a weaker domestic economy, and that generally requires rate cuts. So between those two events, if one of them pulls in a stronger direction, faster or stronger, that's going to lead them to make a decision. So right now they're kind of caught in the middle. They're basically in wait and see mode. And when I mean by what they're nimble, when I say that they're nimble, they're basically waiting to see, is inflation going to creep up faster than the domestic economy is going to get weaker, or is the domestic economy going to start to pick up a little bit more, allowing them to combat inflation? So, they're kind of caught in the middle, and they've got two things pulling at them, and they're basically in wait and see mode. I don't think that they're going to do anything for a while. I think the data is putting them in a spot where they probably just have to do nothing, and everything's probably going to be okay in the short term. In the long term, it really comes down to Kuzma, the tariffs, domestic economy. You've got this, basically like a wildfire with the Iran war that can really spread out of control, as we've kind of seen in the past with oil prices. And so we've got a lot of things that the Bank of Canada kind of has to balance. Unfortunately, they've got to kind of use each leg with, trying to figure out if they're going to, accelerate with a rate hike, or they're going to move in the other direction with a rate cut.
And where does the loonie factor in with this? How important is it to the Bank of Canada?
Sure. Yeah. So, I mean, the loonie is, is obviously important. Weak loonie does help, the domestic economy to some extent. But really, the loonie is following a U.S. dollar story. And what's driving the U.S. dollar higher is obviously the U.S. Fed. And the expectation is the Fed is probably going to raise rates before the Bank of Canada, potentially sometime by the end of the year. And that's driving U.S. interest rates higher. When the interest rate gap in the differential between the U.S. and Canada, increase, that drives flow of funds into the U.S. dollar. That's where the money flows. So that's why the loonie has been so weak recently, and the U.S. dollar is basically being strong. It's really a U.S. dollar story. So on the other side, you really have to look at what's happening with U.S. inflation and the U.S. economy, and what the U.S. Fed is going to do. And it looks like the Fed, the data yesterday came out with, somewhat, more tapered inflation, but the U.S. Fed is still more likely to increase rates before the Bank of Canada. That's causing, the U.S. dollar to get stronger, flow of funds, moving, into the U.S. with the interest rate differential. And that's basically what's, kind of making the loonie so soft recently.
And does that put pressure with the Fed potentially hiking? Does that put pressure on the Bank of Canada to do the same, to try and keep that gap to a minimum?
Yeah, it can. Everything is going to come down to inflation and the domestic economy. So generally, historically speaking, the Canadian and the U.S. economies have, somewhat been tied to the hip directionally. And, that's generally been the case. And we expect that to continue to be the case, except Canada this time has some different problems with, Kuzma and tariffs, which could push both economies in a different direction. So the balancing act is really going to come down to, how hot can inflation get before the Bank of Canada has to act, or how weak can the domestic Canadian economy get before the Bank of Canada has to, potentially reduce rates. So generally, Canadian economy follows the U.S. economy and global growth generally. But in this case, they're going to have to pay a little bit more particular attention to inflation, and obviously the domestic economy. And then they're going to have to make a decision to decide, which wildfire they want to put out between those two. And right now they're kind of stuck in the middle with wait and see mode.
It doesn't sound like a really good place to be right now. Where do you see the dollar going over the next couple of years?
So I think in the short term, we're going to see a strong U.S. dollar. I don't think the issues in the Middle East are helping with inflation, and the trickle through effect that's going to have, the uncertainty with global growth. So, we've seen a strong U.S. dollar. I think the U.S. dollar continues to remain strong in the short term. I think in the longer term, if you look out 2 to 4 years, I think, the loonie should, benefit from a Canadian economy that, hopefully gets back on track and more normalized inflation. And, we could see the loonie hit, 130 in about 2 to 4 years, so an increase from where we are today. And for that to happen, really, we need to see, the Kuzma and the tariff issue basically get put aside at some point, and some sort of deal be reached when it provides stability into the market. And then outside of that, we want to see all the things that are happening, in the Canadian economy start to, come to fruition and come out in the data. We want to see strong employment, strong GDP numbers, and the Canadian economy really get back on track. So I think in 2 to 4 years, Canada should be able to get itself back on track. That will bode well for the loonie. And, if you build it, they will come. So if you build a Canadian economy, they will come for the loonie, and the loonie will get supported. It all comes down to the economy at the end of the day.
All right, we have to wrap it up there, Rahim, but thank you very much for joining us today.
Thanks for having me.
Rahim Madhavji, president at Knightsbridge Foreign Exchange. Coming up, new motor vehicle sales in Canada saw a nearly 2% decrease in May from a year ago, but it's an entirely different story when you look at electric cars. Sales of those jumped nearly 20%. More on that after the break. EV sales soared in May. They were up nearly 20%. For more on that, CTV's Scott Hurst joins us now to break down the numbers. Scott, thanks as always for joining us, sir. Overall, numbers not so good, but for EVs, boy, oh boy, people are starting to like them, aren't they?
Good morning, Roger. There's been a renewed momentum in EV sales for much of this year, and it appears that interest in electric vehicles is continuing in May, with the latest data from Statistics Canada coming out just a few minutes ago, showing that in the month of May, there have been more than 18,000 sales of electric vehicles across the country. That's similar to the numbers the month before in April. Close to 18,000 EVs were sold across Canada. That number, that month, is up more than 20% from a year earlier, and the numbers are even stronger from March, with Stats Canada showing in that month there were more than 21,000 EV sales in Canada, a spike that is quite significant, and that made up about 12% of all vehicles sold that month, also a big jump from the year before. So the big question, why are car buyers, Roger, like you and me, turning back to these types of vehicles after the industry hit a rough road for much of the year before? In 2024, zero-emission vehicles reached new heights, making up about 14% of new annual sales. Then in 2025, it really was a bumpy ride for the industry, with sales dropping significantly and now renewed interest for much of this year. Industry analysts say there are several factors at play here. Of course, there often are, not just one singular factor, and they point to the new 5-year EV incentive program introduced by the federal government in February, offering rebates of up to $5,000 this year. Couple that new incentive, Roger, with recent surge in gas prices. We've talked about this a lot for the past couple of months, with all the uncertainty over the war with Iran and the closures on again, off again of the Strait of Hormuz, and the impact that has had on all of us when we fill up our gas tanks. And so that is another factor that analysts are pointing to as a reason why many consumers and many of those who are looking to buy cars in the near future are once again considering electric vehicles, plus more familiarity of the vehicles and increased options as well. Of course, Roger, there are still many barriers for people in considering an electric vehicle, cost being one of them. Also, lack of charging infrastructure, maybe not so much in big cities like we're in Toronto and other major cities across the country, but when you get to smaller communities around the country, and you might have heard the term as well, range anxiety, concerns over range, and of course, performance in extreme conditions. So there are still barriers that many consider when trying to consider whether they want to go with a gas-powered or electric vehicle car, but we have seen really renewed momentum in EV sales, Roger, for much of the year, and it appears to be continuing with this latest data from Stats Canada coming out just a few minutes ago about EV sales for the month of May, up again for this year.
And it'll be interesting to see with the Chinese EVs coming on the market what kind of an impact that has.
That could be something else. That could be a factor when people are considering vehicles. We talk about choice and options as well.
All right, Scott, we'll wrap it up there. Thanks as always.
Thanks, Roger.
Scott Hurst from CTV News. Up next, De Beers is suspending production at its Venetia mine in South Africa for 2 years amid continued weakness in the diamond market. More on that in a moment. Yesterday on Market Call, we were joined by Keith Richards, President and Chief Portfolio Manager at Value Trend Wealth Management. His focus, technical analysis. His top picks were Microsoft, Coca-Cola, Bloomberg as well. Today on the show, we have more technical analysis with Colin Jasinski, portfolio manager and chief market strategist at SIA Wealth Management. All right, mining giant De Beers is suspending production at South Africa's largest diamond mine for 2 years amid continued weakness in the diamond market. De Beers is majority owned by Anglo American, which is reportedly seeking to sell the business as part of a broader strategy to refocus on copper. We got more from Gracelyn Bascarin, founding director of the Critical Mineral Security Program at the Center for Strategic and International Studies.
The diamond industry are actually demand driven. 10 years ago, 1% of global diamond sales were from lab grown diamonds. Today, they're about 20% of diamond sales. Lab grown diamonds are now cheaper. We know that they don't have issues around blood diamonds. And so what we've seen is that takeoff of the industry has led to structural weakness. And we know that earlier this year in February, De Beers actually had to cut its valuation by half. So you're feeling the material consequences, and it's not clear when that turnaround will take place.
But I mean, we do know, like, people often associate diamonds with the luxury market. But what other applications does the commodity have beyond jewelry?
You know, one of the big focuses in the industry now is industrial use for defense technologies. However, that does remain a relatively small use of it. And when you think about it holistically, most minerals are very small. They generally use 0.5% to 1% when it comes to the defense industry. So while there are these other uses, they're not necessarily the demand drivers. And the substitution of lab-grown diamonds is really significant.
Okay, so now let's hone in, talk about De Beers diamond mine in particular in South Africa. How important is the De Beers diamond operation in South Africa when it comes to economic output?
It's really significant. I mean, you're talking about 4,400 jobs and 40% of South Africa's diamond output. So those are both significant when you think about production, export, and jobs. So it's certainly a loss that will be felt. And keep in mind that South Africa's mining industry has been on the decline for some years. 20 years ago, South Africa was attracting 5% of global mineral exploration. Today, it's less than 1%. So this is really kind of a kick you when you're down situation.
Wow. But I mean, South Africa does still have more than 40 listed diamond projects. But given the shutdown of this mine in particular, how likely is it that we'll see similar stories with some of the other projects in South Africa?
You know, it's a little bit early to tell. I mean, as a whole, what we really expect to happen out of this is De Beers to increase production at other mines. So they're essentially reducing putting this project on pause, but increasing production at other projects. But again, for a mine that is 40% of output, you're really seeing the lion's share go away here.
By increasing production at other mines, you mean other mines in South Africa, other projects in South Africa?
Globally.
Globally. Got it. Okay, so the shutdown, though, it appears to be like a temporary 2-year halt at this point, at least. Is the company expecting the diamond industry, are they expecting some kind of recovery in the industry, do you think? Like, why the 2-year halt?
Look, a 2-year pause isn't uncommon in the mining industry. Generally, what we do is we put mines on care and maintenance. And the benefit of care and maintenance is you don't have to start the mine closure process. It also makes it easier to sell. So it's really a watch and wait to see whether the industry recovers, but also absolutely an asset that could be sold in that process if there's a willing buyer.
You talk about if the industry recovers. How likely is that? Is a recovery or a turnaround, given, as you say, the popularity of lab-grown diamonds instead?
Look, I don't think the future of diamonds is particularly optimistic as it relates to the core driver, right? You know, there was a slogan, every girl needs a diamond. Generationally, what we're seeing now is that people are not getting married. They're proposing with different stones, right? Sapphires, rubies, etc. And 3, the growth of synthetic diamonds. So all of those factors are making the outlook for turning this around a little bit different to maybe a traditional commodity cycle. But again, they're drilling into developing new uses for this, particularly on industrial applications and defense.
Okay, I take your point there, but just hypothetically, like if the mine were to resume operations, would the operator need to pursue substantial cost reductions to ensure the asset remains economically viable in the future?
Look, the profit margin for the diamond industry is certainly diminished. So if the profit margin is declining and you want to keep a mine open, that's going to require substantial infrastructure investments to cut costs. Obviously, in South Africa, there are particularly a few of those costs. Energy rates for mines are regularly cited as a key constraint. Rail, so transportation costs can be quite steep. So these are the factors that give it a fighting chance at being reopened. But again, structural factors largely controlled by state-owned enterprises that, again, sometimes are struggling.
Okay, let's get to the other side of the story as well, and that's the Anglo American is looking to sell De Beers as part of a broader turnaround strategy that would see it focus more on copper instead of diamonds. Would you say the copper has been kind of like become the commodity of choice right now?
Copper is definitely the commodity of the moment. When you look at the lion's share of mineral exploration in jurisdictions from the Democratic Republic of Congo to Argentina, it is copper. In general, mineral prices have been struggling owing to various geopolitical and economic factors. Copper prices are doing very, very well. And a lot of that is because copper is used in data centers. It's used in electrification build out. So it's in sectors of the economy that we know are going to grow. So this is this kind of focus, right? They've also spun out their platinum business. It's now Valterra Platinum. So Anglo American spin out goes beyond diamonds to double down on the copper business. But we've seen other companies do this. This is the same thing that BHP did when they sold out of their nickel and doubled down on their copper. We see South 32 doubling down on their base metals business, moving away from their aluminum business. So it's a larger industry trend, certainly.
And how challenging do you think it would be for Anglo American to sell off that side of things, the De Beers side, given the kind of market backdrop of diamonds right now?
It's very difficult. That they've been looking to sell that off for quite some time, and they've continued to cut the valuation of that business. Generally, when you look at a commodity, you are looking at when is it going to recover. But given the pretenses under which the diamond industry is coming down, particularly synthetic diamonds, that's not a clear turnaround story, if ever. So certainly Anglo American, it's been, an objective they've had for quite some years now. And the question is almost how low does the valuation have to go before it can be sold.
And Lindsay was speaking with Gracelyn Bascaran, founding director of the Critical Minerals Security Program at the Center for Strategic and International Studies. And let's take a look at the U.S. futures as we get ready for the countdown to the opening bells. And taking a look, looks like it's going to be an update, at least right now it does. The NASDAQ up by about a half point, and the S&P 500 by 0.21. Some of the factors, ASML earnings beat came out, confirming the AI chip demand. That was a big thing right now. That soft U.S. inflation data from yesterday still weighing today and driving things. And, of course, the strong bank earnings. And finally, the Fed rates, they said they're well positioned, according to the New York Fed President John Williams. And a quick look at the loonie ahead of the BOC rate announcement at 9:45. It's almost a wash, off ever so slightly right now. And the opening bells are coming up next. Time for the opening bells of the NASDAQ. The North Shore Animal League America, one of the largest no-kill shelters in the U.S., is ringing the bell. I think they brought some puppies there as well. Who doesn't love puppies at the NASDAQ? And for the New York Stock Exchange, the FIFA World Cup 2026 New York, New Jersey host committee is ringing the bell there. Of course, the other semifinal happening today, New Jersey and Argentina. They're setting it up as a war. Winner moves on to play Spain in the final on the weekend. Time now for the opening bell. This is BNN Bloomberg. Trading is just getting underway. And let's check in on the equity markets, see how they are responding to the day. Look at that. You can see the TSX, that's pushing up into record territory right now, up by 0.2%. The S&P 500 up by 0.38%. And the NASDAQ as well, rallying today. Lots of positive indicators for the markets right now. It's up by 0.66%. And a couple of stocks we're keeping an eye on the TSX. Canfor is permanently closing its pulp mill in Prince George, British Columbia. Up slightly on that news right now. The Northwood closure will result in an annual reduction of about 300,000 tons of pulp production. The sector has been hit with shifts in the global market, creating an oversupply and a decrease in pulp prices, resulting in financial losses for the company. About 300 employees are affected by the closure. And south of the border, Morgan Stanley. It had its earnings report out this morning, and you can see it's rallying up about 3%. Joins its Wall Street peers with a stock trading boon driving its results. They set another quarterly record, taking in $6.3 billion from equity trading, a 69% jump, besting its previous all-time high. And the firm pulled in $148.1 billion in net new assets in its wealth management business, far more than analysts had expected, just over half related to IPOs. Coming up, Citi shares its strategy for building your portfolio for the second half of the year. That's when we return. Two Canadian cargo ships have been stuck in the Strait of Hormuz for months as U.S. President Donald Trump reimposes a naval blockade. CTV's Judy Trin reports.
As the ceasefire in the Middle East breaks down, two cargo ships owned by Quebec company Desgagnés Maritime Transport are stuck in the danger zone, stranded in the Strait of Hormuz for 136 days.
The tension is extreme right now. So I'll say we were a little bit unlucky in the time and space here.
On the weekend, Tehran launched attacks on tankers belonging to U.S. regional allies, while Washington struck Iran's ports and vessels. Donald Trump is reimposing the naval blockade and walking back plans to charge ships protection fees. The U.S. president says several Gulf states made him a different offer.
It was never fair to me that we would be guarding the strait when we basically don't take anything. We don't need the oil at all. They said we'd love to do it a different way. We'd love to invest in the United States with billions and billions of dollars.
Desgagnés' two ships should have returned to Canada weeks ago to sail to the Arctic during the ice melt. To deliver essential supplies to northern communities, the company has had to hire European ships.
This was a big cost. So we had to brought the ship here in Montreal, pay the fuel, pay the crew, pay the renting of the ship.
There are currently no Canadians on board Desgagnés' stranded ships. Most of its sailors are from the Philippines or Ukraine. And just 3 weeks ago, the company was able to get replacement merchant marines aboard its ships.
CTV's Judy Trin. Well, earnings season is picking up with some major U.S. banks reporting results yesterday and into today, and more companies are set to follow. Investors, of course, looking to the second half of 2026, and a new report from Citi says it's important to stay selective when positioning a portfolio. Let's get more now from Jean Sun, Head of Portfolio Advisory at Citi Wealth. Jean, thanks very much for joining us.
Thank you so much for having me. It's great to be here.
Okay, we're starting earnings season, seeing some numbers. The banks, a lot of the banks, your thoughts on how things are shaping up overall?
Yeah, for us, we have our North Star with earnings and fundamentals. And so what we're seeing so far continues to support the view that, as you've said, we want to stay fully invested within portfolios, but we also want to be mindful of risk and mindful of this positioning and where there might be some vulnerabilities. And so for us, when we think about our portfolio positioning, where we've been most comfortable, especially in equities, has been U.S. large cap, where earnings have been resilient. There's been the greatest visibility into where growth is coming from. You've mentioned banks, which we have started off earnings season with, and so kind of a lot of validation in what we're seeing in actual earnings. But of course, there's a long way to go in earnings season, and one of the big drivers has been coming from secular growth, AI, and so we'll be watching really closely for continued language around, just the commitment to AI CapEx and also where those drivers are coming from. But for us, that's where we can reduce some of the, whether it's cyclical or even like geopolitical risk vulnerabilities, like those areas are where we're seeing the strongest strength coming from and sources of strength for earnings.
All right, with tech stocks, when they start reporting their earnings, what might be some warning bells you'll be looking for?
Yeah, for us, it's going to come down to just how how companies are guiding towards, the capex outlooks, whether or not we're getting the continued, commitments really to just investing in this space. It will also highlight that one of the other themes that we talked about in our third quarter piece was also just the continued evolution of what this growth is looking like for AI investment. So there's been a lot of focus on whether or not there's going to be revenues and ROI coming out of the investments being made, but every investment dollar being put to work, whether it's from hyperscalers or others, is someone else's revenues. And we've been talking about as a team over time where that's been benefiting other parts of the market, whether it's been in chips and memory. But the one that we wanted to call out this quarter was around cybersecurity. And of course, cyber's had a nice run recently, and valuations are a little bit higher relative to software sector as a whole. But because of the developments in AI, the continued investment in cyber is going to be another extension of where we see investments related to kind of like how AI is developing over time. And so for us, that's another theme that we wanted to highlight in third quarter, but also just more broadly for us, this is more of a multi-year theme because right now, as we've seen kind of like where IT spend has gone, CapEx has been, or cyber has been growing as a part of IT spend. And we expect that to continue, particularly as AI models become faster and better over time.
Okay, and in fixed income, you continue to be underweight. What's driving you there?
For us, it's the sense that correlations, historical correlations of fixed income to equities have actually broken down a little bit. And so when we look at where some of the volatility is coming from, it's been more on the rate side. And because inflation continues to remain sticky, I know we got a more benign report this week, both today as well as yesterday, but it's still higher than what central bank targets are allowing for, and this is across the globe. It's also that there's been concerns about fiscal discipline and just especially in the US, growth remains pretty strong. And so you have a combination of these things, which leads us to have risks to the upside when it comes to rates, particularly on the long end. So we want to stay a little bit shorter duration in our portfolios, but then you couple that with where credit spreads are, and they're incredibly tight in a historical context. So when we take all of that together, what we wanted to do is make sure that our portfolios were working as a whole. And that led us to a position where treasuries and fixed income aren't playing the same sort of ballast and protective role that it might have in the past. And so what we did last year actually was add a position in gold to add additional diversification. And I saw that you had a commodities conversation earlier. That's one of the things that we also highlighted in this piece. It's just, where are you getting your diversification from? In historical context, there was kind of like that fixed income equities balance. Today, we want to be more thoughtful in thinking through where we are in the cycle and where a prudent investor might add more diversification by adding a newer asset class or something that helps the overall portfolio correlations.
All right, and with gold, are you looking at gold itself or stocks?
Looking at gold itself, because I think what we want to do is really focus on the purest play and where those corollary benefits come from. But in that regard, I will call out, it's a relatively smaller position in portfolios. It's just part of it is to replace what typically was a role played by long duration treasuries.
All right. And but for now, though, gold is going to take that. Where do you see gold going?
For us, that's not been the primary reason. There's certainly benefit from continued buying by central banks. We see, especially with the pullback that we've seen recently, there's been a cleansing perhaps of positioning. And so there is more potential upside. But again, the view for us hasn't been really predicated on a forecast per se. It's been around the portfolio benefits and the correlation benefits that gold as a position within a multi-asset portfolio can provide. And that ballast in the face of a lot of uncertainties, particularly with inflation running higher than trend.
Okay, we'll leave it there, Jean, but thank you very much for joining us.
Thank you so much for having me.
Jean Sun, Head of Portfolio Advisory at Citi Wealth. Just ahead, we'll get the Bank of Canada's interest rate decision amid rising trade uncertainty, renewed tensions between the U.S. and Iran as well. That's coming up after the break. couple of minutes away from the Bank of Canada announcing its 5th interest rate decision of the year. Let's break it down with Ed Devlin, founder of Devlin Capital. Ed, just a couple of minutes before we have to jump in, but I know you're going to come back a little later on. What are we expecting?
We expect no change in the policy rate. I would expect them to be relatively balanced, maybe lean a bit on the dovish side, just given all the heightened uncertainties around trade and in the energy markets.
What will you be looking for? What will you be listening for from Tiff Macklem?
Just how concerned they are about, headline inflation leaking into core. It looks relatively contained to me, but if they express concerns, I would see that as hawkish. Also, maybe any thoughts they have in the pretty uneven housing market, and how they're looking at the breakdown of the labor markets, especially on the youth side.
Okay, we're going to have to cut you off there. I know we're going to talk to you in a sec, but we'll come back to you, Ed. We've got the Bank of Canada rate coming out. And to help break it down, unchanged at 2.25%. No surprise there. Let's get some of the highlights from Bloomberg's Stephanie Hughes. I guess, Stephanie, thanks for joining us on this. I guess that is the highlight. We kind of no surprise on this one, is there?
Absolutely, Roger. Yeah, as widely expected by economists, the Bank of Canada held the overnight rate to 2.25% as they're sort of weighing an uncertain outlook with these oil price shocks translating into inflation, and then against an improving economic backdrop. So we've got a few headlines here. Of course, the key rate being left at 2.25%. The Bank of Canada sees CPI inflation at 2.5% this year. That's up from the previous 2.3%, and forecasts CPI inflation to ease to 2% next year. So the Bank of Canada also did cut its 2026 GDP growth forecast to 0.7%. That's down from 1.2%. They add that, probably unsurprisingly, uncertainty is still quite high, just given the conflict in the Middle East, economic uncertainty, everything on that front. So there's a lot going on here in the monetary policy report that they also released today. So what they did do also is upgrade their 2027 growth forecast to 1.8% from 1.6%, and also said the economy is showing signs of improvement. So there's a few green shoots there. We saw that with some recent jobs numbers and some flash estimate forecasts from Stats Canada. They also lifted their second quarter GDP forecast at 2.5% from 1.5. So yeah, that's the top line going into that. There's war-related cost pressures still being worked into prices, but right now they're buying themselves some time, keeping that rate steady as they're weighing the benefits and the downsides of what they've got going on, the economic uncertainty, the price inflation coming from energy prices from the Middle East conflict, and so on, Roger.
All right, Steph, thank you very much for that breakdown. Appreciate it.
Thank you.
Okay, BNN Bloomberg's Stephanie Hughes. Let's bring Ed back in here to get his thoughts on the number. And I don't know if you've had a chance to start looking at what Tiff Macklem had to say, and you heard Steph there. Your thoughts?
Yeah, I just heard Steph, so I'm a little bit blind, but things that caught my eye there were that, they kind of downgraded growth next year, and it sounds like they upgraded growth the year after. That's kind of a classic thing that central banks do when they see growth slowing, but they don't want to cut rates. So they boost the outlying years up to keep the output gap relatively unchanged. So the other thing I think that I thought, everything else looked kind of normal. We do know we had a really soft patch then, but it seems to have picked up. So hence the upgrade in the most recent quarter's forecast for growth. Yeah, it looks pretty much as I would have expected as we headed in.
All right, I'm just trying to pulling up some of the headlines here. Leave the rate. They're expecting inflation to stay elevated. One of the other things, they expect growth to come in at 1.7% in 2027 and 2028 GDP growth. 1.8%, 0.7% for 2026. I'm just reading these numbers on the fly. 1.8 for 27 and 28. Saying as recovery proceeds, economic slack will be gradually absorbed. Where does this set things up for what lies ahead? Can we see cuts, or are we going to see hikes still?
I think we see given what we've got right now, I see no change in policy this year. I think they're looking for underlying trends, and they're very hard to find right now because of all the short-term uncertainty. So the market right now has one rate hike priced into Canada this year. I would bet against that. I think they'll probably stay unchanged. Now, the other thing I would say is these are all point estimates that the bank have put out, and I think there's tremendous volatility around these point estimates. How long does this war with Iran go on, right? What is the next round of tariffs? There's a lot of real uncertainty here, and I think the Bank of Canada is just trying to keep their powder dry and react to whether we get an upside or a downside surprise.
The word I heard someone else use was stay nimble. Is that what the bank wants to do right now, be able to react either way?
Yeah, it's exactly right. And, I think the bank's done a good job getting rates down to 2.25 in pretty short order, which has provided stimulus. The real question is, do we need more? Or is persistent, energy and food inflation going to leak into the core inflation and make inflation expectations unanchored? And I think if that's the case, especially given the recent bout of high inflation we had as we reopened after the pandemic, I don't think they want to see that at all. And so I think the bank would be very hawkish there. So I think they're ready to move in either direction, and they're just waiting for the data, trends in the data so they can move if they have to.
And how important is CUSMA? I mean, we have sort of a deal right now. I mean, things are kind of running unchanged, but we do have that uncertainty. If we had a longer term contract with the U.S., what kind of an impact would that have?
Well, I think it's through the confidence channels, like both through investment and consumption. And, I think while it's up in the air and it's subject to annual renewals, it's going to weigh on investment and weigh on consumption and weigh a bit on trade. And it's all through the kind of the confidence channel. So that is where we stand right now. I would, there's risks in both directions there. Trump can roll out of bed and decide to start tariffing other things, and that would be the downside surprise. Or he can get distracted, and if my base case is he gets distracted and we kind of stay where we are, and I think that's what the market's broadly pricing. But there's also a chance that we get a surprise that Carney comes up with a deal with them. They're able to negotiate lower tariffs, take some of the aluminum and auto tariffs off or reduce them. And I think the markets would react quite positively to that. So it's unclear. There's both upside and downside risk to this trade situation.
And with the bank, what kind of pressure is it facing if the Fed hikes maybe later this year?
I think it would depend why. I think right now the markets are thinking the Fed might go a couple of times. Warsh is talking quite hawkishly, as he did in his testimony the other day. And he was generically a hawk before when he was on the Fed. So I think he just talked dovishly to get the position. He's now the chair, and I think he'll revert to his normal character, if you will. So I don't think it has a big effect on us. I mean, I think the Canadian dollar would weaken a little bit, which arguably is good for trade. We do have historically pretty wide interest rate differentials between Canada and the U.S., around 1% or so, which is on the high side. So that would maybe widen those interest rate differentials a little bit. But the odds of the Fed going into a sustained tightening cycle without the fundamental reason also affecting Canada, I think is relatively low. So, they do have a stronger economy based on bigger deficits and, this big AI build out that they're doing there. So, at the margin, they're a bit stronger for now. Longer term, how do I see Canada and the U.S. decoupling meaningfully? I think the probability of that is low.
All right, Ed, thanks for coming along for the ride. There was a little bit helter-skelter, but we appreciate it with you breaking things down for us. Thanks very much.
No problem. Thank you for having me.
All right, Ed Devlin, from the founder of Devlin Capital. Coming up, as expected, the Bank of Canada, we were just talking about, held its policy steady at 2.25%. We'll have more on that after the break. All right, let's take a quick look at the markets and see how they are doing right now. We'll start off with the TSX, which is pushing into record territory right now. They're very, very, very close, if not above it. What's the high? TSX high was on June 17th at 35,629. Not far off it. And it's being brought up mostly by, let's have a look here, mostly by energy and financials right now, consumer staples on the downside, industrials as well. One of the companies we're keeping an eye on is Altius Minerals, and they announced a $181 million bought deal for a public offering of common shares, and that is having a negative impact on them right now. They're off by about almost 14%, so a rough start to today for Altius Minerals. And taking a quick look down south of the border, the S&P 500 and the NASDAQ, where are they sitting right now? Before we go here, you can see S&P 500 up by 0.38 again, also pushing close to record highs. NASDAQ still below after all the big pullback we saw over the last little while, but it is rallying today. It is up by 0.3 as well, almost the same as the S&P 500. So I'm just trying to pull up NASDAQ and see who's leading the way for them right now. And you got PayPal, of course, on the rumors that it might be bought. So we're seeing that rally 14% right now. All right, coming up, as expected, the Bank of Canada held its policy rate steady at 2.25%. More on that after the break. Welcome to the second hour of The Open. Let's take a look at some of the stories we are following in the BNN Bloomberg newsroom. No real surprise here. The Bank of Canada has left its key rate unchanged at 2.25%. Central Bank says economic growth has been weak but is set to pick up and warns that war-related cost pressures are still working into prices. The bank also cut its 2026 GDP outlook to 0.7% while upgrading next year's growth forecast to 1.8%. The bank notes, however, that the 2027 inflation forecast depends on energy prices. While the U.S. has continued its fifth day of airstrikes on Iran, U.S. President Donald Trump vowing to intensify the attacks until Tehran stops attacking ships in the Strait of Hormuz and opens the waterway. Strikes have been focused on military targets in the country's south. A U.S.-Iran peace deal has all but collapsed over the past week as the two sides fight over control of the strait. Bloomberg is reporting that First Quantum Minerals is looking to sell a stake in one of its copper projects. According to the report, the miner is in talks to sell a minority stake in its project in Argentina to rival miners and strategic investors. Potential buyers including Rio Tinto and Mitsubishi. Now, the project could produce more than 320,000 tons of copper a year. And an up day for the markets right now. The TSX up by 0.23%, not far off its record high set last month south of the border. The S&P 500 also closing in. It's up by 0.44%. And the NASDAQ, nice little rally going. It is up by 0.63%. As expected, the Bank of Canada held its policy rate steady today as the central bank balances a weak economy with inflation heating up. Joining us now, Benjamin Tal, Deputy Chief Economist at CIBC. And Benjamin, thanks very much for joining us.
Thank you. A pleasure.
All right. This is what they had to do. They really didn't have any options, did they?
Big shock, surprise. I'm shocked. The Bank of Canada did not move. Listen, nobody expected them to move. They did not expect to move. What is the real and ultimate measure of intelligence? It's basically what you do when you don't know what to do. And if that's the case, the next few quarters will test the economic IQ of every central banker in the universe, because let's face it, they admit that they have no clue what's happening, given what's happening with Iran. So what do you do when you don't know what to do? you don't take chances. And that's exactly what the Bank of Canada did today. And I believe that's what the Fed will be doing soon, namely a situation in which you just wait and see. The Bank of Canada is not in a position to cut or raise interest rates anytime soon. So they are basically doing nothing. That's the right thing to do.
It can be the right thing to do. Is oil, is that the big focus? What's unfolding in the Middle East? Is that on everybody's plate?
Absolutely. Oil is everywhere because oil is food, oil is manufacturing, oil is transportation. And if it continues to go up, we have an issue. We have to remember that almost every economic recession was led by an oil shock. If you go to 73, 91, even the 2006 mother of all recessions was led by a significant increase in oil prices. So people say oil prices or oil shocks lead to recessions. No. It was the response to oil shocks, namely higher interest rates, that killed the economy back then. And that's more or less where we are. If for some reason the Bank of Canada and more importantly, the Fed will start raising interest rates because of elevated oil prices, we have an issue, maybe a recessionary scenario. The hope and the prayer is that will not happen. This is our working assumption that the Bank of Canada is basically going to focus on energy, and energy is Trump and Iran. And both sides, Iran and the U.S., are highly motivated to find some sort of a fast-saving solution because Iran needs the oil money and Trump cannot afford 100 oil. That's more or less where we are. So that's our working assumption. And by the way, I believe that that's the Bank of Canada's working assumption as well.
I was going to ask you, I mean, oil's hovering around 80 a barrel right now. It hasn't really moved much today, but is 100 the one where it gets concerning?
Exactly. I think that at 70, 80, 85, we are fine. On a year-over-year, we'll be fine. But if you go to 100, 120, go back to where we were a few months ago, then all bets are off.
And what other factors? How important, the trade uncertainty that we have going on? What kind of a factor is that playing?
Well, it's definitely a factor, not as important as it was a few months ago. If you listen to the Bank of Canada and their survey of business confidence, businesses are telling you know what, we are finding a way to maneuver the situation. It's not that it's not important, but it's not dominating the way it used to. Clearly, the conflict with Iran is the number one issue. If there is some sort of solution or resolution to this, and I think there will be, I think that would be very positive for growth. And I think that that's the hidden assumption when it comes to the Bank of Canada and when they are forecasting 1.8% GDP growth in 2027. So in many ways, what we are seeing now is 2026 as a transition year between something bad and something better.
Okay, so the optimism with the GDP then is what you're saying?
Absolutely. And I think that it's all about the working assumption regarding USMCA and clearly the war. I think that the working assumption is that there will be some sort of resolution to the tariff situation because, let's face it, time is not on Trump's side. He needs to find some sort of resolution. Clearly, they are paying for 93% of the tariff. It's not working. So they will have to compromise one way or another. It will be by sector. If I'm dairy, I'm nervous. If I'm lumber, I'm nervous. If I'm energy, I'm not nervous. So I think it will be deep but narrow, namely the impact of this kind of resolution will be by sector. Some sectors will face the pain, but the overall story will be more positive than feared. That's the tariff situation. The energy situation, nobody knows. Trump himself does not know. But again, if you use common sense, both sides are highly motivated to find some sort of resolution to the crisis.
All right, and going back a little, he talked about second quarter. We saw that growth, the upswing for the GDP, but he said that may not be sustained. Any concerns that might then carry into the next couple of quarters and into 27?
Absolutely, no question about it. I think that clearly Q1 was weak. The unemployment rate is still elevated. The labor market is weak, as suggested by the Bank of Canada. The 2% that we expect for the second quarter is not going to last. So that's why the uncertainty regarding tariffs and clearly what's happening with energy will be a major factor impacting the trajectory in 2027.
And talking about the jobs, we saw 18,000 jobs added in June. A lot of them, though, were part-time. What does that tell you and where does that factor in?
Well, the labor market in Canada is not strong, no question about it. It's not strong by any stretch of the imagination, and I think that that will continue to be the case for the next few months. When you have uncertainty regarding tariff and regarding oil, you really are not in a position of hiring. Youth unemployment improved, but it's not great by any stretch of the imagination. So I think that clearly keeping interest rates at 2.25 is the right thing to do. We have a housing market that is in a semi-recession, so we need some stimulation in this market. We need some energy to inject energy into the economy, and therefore it's simply the right thing to keep interest rates low. By the way, I believe that if it was not for the war with Iran, we would be sitting now at 2% overnight rate, not 2.25.
All right, and with the dollar, what kind of a factor is that in all this? Where do you see that playing out?
Yes, first of all, we have clearly the energy story that is positive for our loonie, but at the same time, we have a situation in which people are toying with the idea of the Fed actually raising interest rates. As you know, the market is pricing in at least 25 basis points increase by the Fed by the end of the year. That will put some pressure on the Canadian dollar, downward pressure. So our guess is that the Canadian dollar at this point is vulnerable and might lose some ground over the next few months.
And does that play a factor with the bank would that put pressure to try and keep up with the Fed?
No, I don't think so. I don't think that that's important enough. We are talking about decimal places here. No, not a big deal here.
Okay, and not worried too much about a growing spread between the Bank of Canada and the Fed?
Yeah, I think they will tolerate that. I think they will tolerate it. I doubt that the Fed will be raising interest rates anytime soon. Our call is that the Fed will do nothing by the end of the year because the U.S. economy is not as strong as perceived. Even the Bank of Canada admits that the strength of the U.S. economy is based on the consumer, which is the wealth effect, namely wealthy consumers spending stock market money, and clearly AI. This is a very narrow base. The economy as a whole is not strong in the US. And if we are right or even semi-right about energy inflation will not be as significant over the next 6 months. Another reason for the Fed not to raise interest rates anytime soon.
All right, Benjamin, appreciate this. Thank you very much for joining us.
Thank you. My pleasure.
Benjamin Tal, Deputy Chief Economist at CIBC. A reminder, we will get the Bank of Canada news conference at 10:45 today. We'll bring that to you live. Coming up, Morgan Stanley, BlackRock, and Johnson & Johnson are among some of the companies who posted earnings today. We'll check in on how those stocks are moving when we come back. BlackRock, Morgan Stanley, Johnson & Johnson all posting their second quarter earnings today, joining the list of major U.S. banks who reported yesterday. More still to come, of course. For more, I'm joined by Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Jonathan, thanks very much for joining us today.
Good morning. Thanks for having me.
Okay, I know they're very disparate to a degree. Overall, when you see those earnings reports, what does that tell you about how it looks when it comes to the earnings season?
You know, historically, we wait for the beginning of earnings season to come. That'll hopefully give us some sort of guide, some sort of insight to what's ahead of us. Historically, earnings season has helped buoy the market, give a little bit more confidence. Obviously, we're getting a little bit more insight as to what happened last quarter and what the outlook is for moving to the next quarter ahead of us. And what we're seeing now is in the beginning of earnings season now is we're getting some of the financials and some other big names that are out there. Earnings season so far has been a upward surprise. The numbers that have come in have clearly helped our markets, have helped sentiment, and it shouldn't be that surprising. Like I think there is an issue with mismanagement here as far as the expectations. Maybe the bar isn't set too high or high enough at this point right now. But as we're beginning earnings season, we're getting blowout numbers from some of the financials here. But that is in line with what we've seen in prior quarters, and it's what's in line with what we've seen last quarter, right? When you talk about the financials specifically, trading activity has increased over time. We continue to hear that headline coming out of these earnings reports. M&A activity, which was sidelined for quite some time, has now come back into the market market. We've picked up a lot of steam with that, and that's going to continue, right? The M&A activity, the syndicate, the IPO markets are going to continue for quarters ahead. So that's a little bit of insight of how the financials are going to do moving forward as we talk about these large IPOs coming to market. And also from the wealth management side, right? BlackRock would fall into that category there. Some of the bigger names, the Wells Fargo's, Cities. Wealth management has performed very well because clients' assets have continued to increase. As our economy has gotten better, our markets have gotten better, their assets have continued to increase, which generate more fees and more revenue. So that's just a natural progression there. So I think overall, as we're getting into the beginning stages of earnings season here, the sentiment is set high.
Yeah, I mean, BlackRock, what are they at now? $15.3 trillion in assets. Incredible.
Absolutely, and they've increased and announced they repurchase stock repurchase, which is always a positive sentiment. BlackRock is one of the gorillas in the room that's out there. They continue to produce record revenue, right? Their mantra is a little bit different than the institutional banks. They're out there, using private equity to buy companies and spin them off and sell them off. We're going to continue to see that. I'll go back to what I said before. There's been this kind of lull in the IPO and the syndicate market for waiting for, quote unquote, the right time for these companies to come public. They've waited quite some time. Some have tested the waters. We've seen SpaceX. We've seen a few others. We're going to continue to see that down the road. That's going to be very beneficial for companies, for the larger banks and institutions and companies like BlackRock.
Now, any worry that then the train will run out of steam after that?
Run out of steam. So, where does this all go from here, right? We've got these geopolitical risks that are in front of us that seems to have not been able to derail the markets. We continue to move higher and higher. Even over the past 48 hours news cycle, it seems like things are escalating there, yet the market continues to shrug that off. Our economy, our economic data that we're getting is showing that things are getting stronger. Inflation is coming down. We've got consumers who are feel a little bit more comfortable where interest rates are as far as real estate is concerned. So we do have positive sentiments that's there. We're going to continue to talk about the Fed and what they're going to do with interest rates coming into 2026. We were talking about multiple cuts. Now we're talking about multiple hikes. So yes, there are headwinds that are here. The train can, quote unquote, get derailed. But I think we're in a point of where we're 2 steps forward, 1 step back. The market continues to move higher. We're going to get some negative headlines, some negative sentiment. The market might pull back a bit. You might lose, 1, 2, 3% over a short period of time. And then it'll find a bottom, regain back up again. And we continue to see this pattern over and over. So I think from a trading point of view, you got to be careful because the market will turn. And when it does turn, it will turn quickly. From a investing point of view, long road ahead of you, slow and steady. Yes, there's going to be ups and downs, but there's going to be more of an upward trajectory than a downward trajectory.
And with oil and with what's unfolding in Iran right now, the markets seem to be ignoring it, the 5 days of attacks. What would be a point where they can't ignore it? Would be oil at 100 or it escalating in the Middle East?
Yeah, I think the markets are somewhat ignoring the positive news that can potentially come out of there, right? The strait is open, the ceasefire is on, right? We've kind of played that game over and over again, and we're kind of ignoring that. I think if we continue to see this escalation, which we're seeing now, I think that's the one that's really going to get some serious attention. This was supposed to be a couple of weeks. We've turned into 100+ days at this point right now. It's clearly in an inning of escalation as opposed to de-escalation. If we continue to see that, I think that's what's going to start to shake our markets a little more. Oil, again, if oil trended below 80 for a very short period of time. We're heading back up above those levels there. Yes, if this continues in that upward trajectory, I think that's when we're going to see some pressure on the market. We used to have this inverse relation when the VIX went lower, the market went higher, and conversely, we've moved the VIX out of there. We've inserted oil. We're watching oil, and whatever oil does, the market does in an inverse relation. So I'll continue to keep an eye on that.
Okay, we have to wrap it up there, Jonathan, but thanks very much for joining us.
Have a great day. Thank you.
Cheers, you too. Jonathan Corpina, Senior Managing Partner at Meridian Equity Partners. Coming up, the country's largest city is seeing air quality that is among the worst in the world as wildfire smoke from north of it blankets the city. More on that next. Toronto's air quality is among the worst in the world. It's being blanketed by wildfire smoke from up north. For more on this, we're joined by CTV's Renee Rogers. And Renee, thank you very much for joining us.
Nice to see you too, Roger. And in fact,
we can barely see each other with that smoke outside. It's really bad out there. We're here in Toronto, and it's really bad out there.
It is really bad out there. And also, did you see that orange sky this morning, Roger?
It was. I mean, it's beautiful to look at, but when you realize what's causing it, not so nice.
That's right. And I noticed that you mentioned among the Toronto's air quality is among the worst in the world. And that was true up until about 9 o'clock today, Roger, when it actually reached the top.
Wow.
The worst, the absolute worst air quality in the world. I think there were a couple of other cities following it. One was in India. One was in the Democratic Republic of Congo. So that gives you an idea. Now, this comes to us from IQ Air. It tracks the air quality all around the world. But it's not just Toronto that is experiencing this sort of thing. It's actually most of southern Ontario. And it's all because of smoke from wildfires up towards northwestern Ontario and several First Nations communities. It's been drifting south, and it's not expected to end anytime soon, at least not for the next couple of days. So Environment Canada has issued an orange air quality warning saying that the air quality is very poor, which puts everyone at risk, regardless of your age or your health. So it's telling you to limit your time outdoors, reschedule any outdoor sports activities or events. It says you may notice even mild symptoms, things like eye, nose, and throat irritation, headaches, or even a mild cough. Now, more severe symptoms would be wheezing, chest pains, or a severe cough. If you think you might be having a medical emergency, seek medical attention. Environment Canada saying conditions may improve, Roger, may improve by Friday morning.
Wow, lasting through until Friday. And the heat is not helping any of this, is it?
It really isn't. So Ontario is still under a heat dome that is stretching from the prairies right through to Quebec. And temperatures in southern Ontario today, anywhere between 30 and 36 degrees for the highs. Then when you factor in the humidex, some areas will feel like 42 degrees. And no, that is not good news at all when it comes to air quality. So IQ Air, the same people who track the air quality around the world, they say that when the air is hot and stagnant like it is, that actually traps pollutants near the ground, right where we are, to breathe them in. And the hot air can also react with emissions from vehicles, from industry, and that creates what we know as smog. And then lastly, as well, the heat also, as we know, Roger, helps fuel wildfires. So really, it's not a very good mix right now. Again, Environment Canada saying that you should watch for any signs of heat exhaustion, headache, nausea, dizziness, that sort of thing. It is also saying that when heat events and air quality events occur at the same time, you should prioritize keeping cool. And once again, don't hesitate to seek medical attention if you think you might need it.
All right. I'm looking at some of those people jogging in this.
I know.
not a recommended thing right now.
Exactly.
Renee, thank you for that. We appreciate it.
You're welcome.
CTV's Renee Rogers. Coming up, we'll bring you the latest headlines and update you on the markets. The Bank of Canada has left its key rate unchanged at 2.25%, the central bank says. Economic growth has been weak, but is set to pick up, and warns that war-related cost pressures are still working into prices. The bank also cut its 2026 GDP outlook 2.7%, while upgrading next year's growth forecast to 1.8%. The bank notes, however, that 27 inflation forecasts depend on energy prices. Manufacturing sales in Canada reached a record high in May. Sales rose 1.3% to 78 billion, making it the fourth consecutive monthly increase. Data from StatsCan shows 14 of the 21 subsectors saw increases, led by transportation equipment and chemicals. The largest decline was in electrical equipment and appliances. Canfor is permanently closing its pulp mill in Prince George, British Columbia. The Northwood closure will result in an annual reduction of about 300,000 tons of pulp production. The sector has been hit with shifts in the global market, creating an oversupply and a decrease in pulp prices, resulting in financial losses for the company. About 300 employees are affected by the closure. And a quick peek at the markets right now. You can see the rally continuing. The TSX climbing up towards a record high set last month. It's up by about 0.42%. S&P 500, same in near record territory, up by 0.36. And the NASDAQ has a rally going. It's up by about a half point right now. Oil prices are approaching the $80 end. They're right around the $80 level. We get more from Bob McNally, president and founder of Rapidan Energy.
Between diplomacy on the one hand and military escalation on the other. I believe communication channels are still open. There's been some reporting on that. But we've just gone back and forth between a diplomatic track and military escalation. Now we're seeing pretty forceful military escalation, but that doesn't preclude that in a week or two we could be back to talks and negotiation. But it's sort of this back and forth. The key thing, though, and you mentioned the oil prices, is the oil prices weren't ready for oscillation. Oil prices by the end of June had priced in perfection, a smooth, sustained normalization of Gulf production and flows. And that was never likely. So I think we're seeing some short covering. There's a lot of short positioning in the market, a lot of short covering, and I think a lot of reality pricing here by a market that wasn't ready even for oscillation between diplomacy and military escalation.
So you don't feel that we're seeing market complacency, that with the market complacency we've been seeing so far, you don't feel we're seeing that today, given everything that's been happening, the back and forth, just even within one day of trading?
No, I think the market complacency that we certainly saw up until the end of last week is now flowing from the market. It is now ending. And I think the market, if you will, the crude market, it's very different. If you look at refined products and look at refinery margins, they're screamingly tight and becoming more so. But the crude market has been very complacent, very short positioned, and what we've seen since the weekend, I think, is causing a correction, a long overdue, I think, correction in prices.
When we're talking about these strikes, I wonder, do you think they have any meaningful impact on Iran's ability to control or enforce security in the Strait of Hormuz?
I think they do. I think the U.S. military has, for many decades, planned on the military operations that would be needed to grade Iran's many asymmetric layered assets that it has to control Hormuz. The key issue was, until recently, the U.S. military hasn't been told to go and do it, right? We didn't do it in the beginning, but we're doing it now. And I think now that the U.S. military is focused on the Strait of Hormuz, and every time Iran hits a tanker, we go and hit 40 radar sites, missile boat sites, and other assets there. So I think the U.S. is getting to it. And I think while you can't get to perfect security along that long coastline, there's always going to be the risk that an Iranian can come out and attack a ship. But I think the U.S. military is going to take the rest of this month, maybe into August, and finish the job of substantially degrading Iran's abilities to threaten shipping. The good news is, even from the beginning, is it appears we have destroyed most of Iran's mine inventory. Had Iran been able to sow thousands of mines, we'd be looking at many months of a disruption rather than many weeks.
Wow. There's also reports that the Houthis and the Saudis have carried out strikes against each other. I wonder, do you think we're heading to more like a broader regional conflict as well? And what would that do as well to oil prices?
That risk is rising. And again, the oil market is not prepared. Crude oil prices have not factored in a threat to Yanbu, the Red Sea port, where Saudi Arabia has been able to redirect so much of its oil, 5 million barrels a day. And the refineries on the Red Sea, much less attacking critical infrastructure. So we think the risk of that is rising. However, again, as part of this sort of muddy, messy oscillation that we're talking about, I think the U.S. and Iran still wish to contain the violence to a level where it doesn't become unmanageable. And that would include major attacks on critical energy infrastructure in Saudi Arabia by the Iranians or by the Houthis. So can't rule it out. The odds of that are rising. But I think both sides, again, are still trying to contain the violence to Hormuz and to just U.S. military bases are being attacked by Iran. We are attacking their Hormuz interdiction assets, as well as some others, nuclear sites and bridges and so forth.
Well, we talk a lot about the Strait of Hormuz, but we know Ukraine is continuing to strike Russian oil refineries. And we know Russia, because of that, is struggling to deliver all of that crude that's been forced to ship overseas because of these Ukrainian strikes. Like, how much more impactful have these attacks been on Russia than any sanctions that the country has seen over the last couple of years?
Much more impactful, Lindsay. Rapidan saw that coming with the increased range of the Ukrainian drone strikes. It was just a matter of time before they took out so much refining capacity, upwards of 40% in Russia, that Russia had to go to a total ban. And if you look what's happened to distillate margins, distillate cracks, as we say in Europe, they're making new records. They just exploded after Russian exports collapsed, and then they announced a short-term ban. So that has been by far the most effective sanction, if you will, that has been put on Putin, is these Ukrainian attacks against the refineries, but also boats and shipping and so forth. It's been much more successful than any sanction we or the Europeans have put into place. And it gets to this point. Again, if you look at the crude oil market, there were, let's say, good things happening. China reduced its imports a lot. We had strategic stock releases. We were able to sneak out more oil from the UAE. So there were good offsets, if you will, with regard to crude. With refined products, everything's gone the wrong way. There haven't been redirects around Hormuz. Russia has had its second largest distillate exporter after the United States now has to ban its exports. And China had severely limited its product exports. So very different markets, if you will. And I think, though, the loose crude oil market, if you will, or the bearish crude oil market is going to catch up to the very tight refined product market as a result of what we're seeing in Iran and Russia.
When you combine the stagnant Hormuz traffic, what we're seeing in Russia, and oil being taken off the market, falling global inventories, do you see a potential breaking point coming?
Certainly possible. I think if we were to have a full closure of Hormuz again, back to 0 to 10% of pre-war flows, I think then, yes, we'd have a catastrophic oil price spike. We dodged a bullet this summer because we have succeeded at liberating a lot of that stranded oil, and flows have increased. Also, China, again, went on a bigger crash diet than most people expected in terms of lowering their imports. Now, China's coming back and they're hungry. So some of these things will wear off. But yes, if we go well into the winter and we have not, been able to restore the bulk of flows from Hormuz, we are going to draw inventories down to levels where demand destruction, demand curtailment through price increases would become necessary. That is a scenario we're looking at from August to September. We averted it. We dodged a bullet, but it would come back on the table if Hormuz remains largely closed.
Lindsay was speaking with Bob McNally, president and founder of Rapidan Energy Group. Coming up, we'll turn our attention back to the Bank of Canada as BOC officials get ready to take questions on today's announcement. We're about 5 minutes away from the Bank of Canada news conference to start in Ottawa after the bank left its key rate on hold. No real surprise there. For more on the rate decision and monetary policy report, we're joined by Stuart Paul, U.S. and Canada economist at Bloomberg Economics. And Stuart, thanks very much for joining us today. We appreciate it. It's been a busy morning.
Yeah, it's certainly been a busy morning. As you mentioned, the Bank of Canada held the overnight rate target steady at 2.25%. That's not really a surprise. What was a surprise to me was just how dovish the press announcement and Governor Macklem's prepared opening remarks were. And when we're assessing the tone of the press release and the opening remarks, we have to keep in mind the current context. The current context is that industry-level growth has been improving materially. Exports are very much so doing well as a consequence of global energy production being halted in the Middle East, and so Canada being the major swing producer and swing exporter globally. Inflation pressures are relatively tame, but headline is still running hot. And the labor market has been improving. The unemployment rate has dropped nearly 0.5 percentage point. And in that context, to hear the central bank describe the labor market as soft and to focus on economic slack really just suggests to me that the central bank is currently, at least, more so focused on sustaining an economic recovery than really driving toward a 2% headline inflation target.
And is that realistic to you, does it feel?
Is reaching the 2% headline inflation target realistic, or the economic
leaning
recovery?
Towards the economic recovery? Is that the way to go?
Well,
do you feel?
Leaning towards the economic recovery, I think that it is true that there is currently economic slack in the Canadian economy. Now, what's interesting is that much of what ails the Canadian economy is far beyond the central bank's control. So it's interesting to see that they're entirely focused on the recovery rather than on the price index, rather than on demand that is contributing to elevated inflation. Now, keep in mind, yes, it is some cost push price pressures that are driving headline inflation. That's downstream of the war in Iran. But when you also see the central bank marking up consumer spending growth, and we see recently printed solid consumer spending and retail sales data, it's difficult to entirely say that underlying price pressures are entirely contained. Keep in mind that the labor market is improving right now, and when that is the case, households do have a little bit more to spend. So it's just an interesting development to see that the central bank is still entirely focused on sustaining an economic recovery where the current headwinds are far beyond the central bank's control. The most that they could do is to address inflation, but instead the central bank, Governor Macklem, and his governing council are entirely focused on undergirding economic activity, trying to offset some of the consequences of the trade war with the U.S., trying to offset some of the drag that's created by the war in Iran and elevated energy prices. It was very clearly a dovish press announcement, and it'll be interesting to see Governor Macklem and Deputy Governor Rogers during the actual press conference itself, see if they can maintain that message all the way through.
And what would you ask them at, are you going to be at the conference? Are you going to be dialing in?
I am not going to be in the conference. I'm here in New York covering economic data. I'll have some of my colleagues at the press conference itself. If I were to put a question to them, it would be very much so focused on whether they are comfortable maintaining such a wide gap between the overnight target rate and the Federal Reserve's federal funds rate target. Of course, we've seen some weakening of CAD over the last several weeks, and I think that it's something that should be brought to the front of the central banker's mind. If you have any sort of weakening of the loonie further, can it create additional inflation pressures that we'll only see in 27 and 28 that would require even a more rapid set of rate increases than if the central bank were to start closing the gap relatively sooner? I think that's maybe the question to push to them.
And does it feel like the Bank of Canada is ready to let the dollar soften a little more?
I don't think that they're all too worried. Apparently, they're not all too worried about the softening of the loonie right now. Again, they struck that dovish tone. When that question has been put to them in the past, the canned answer that they give is that exchange rates float freely, and that's a feature of global central banking and independent monetary policy making. But I think that at least putting the question to them, are they worried about the secondary consequences, the secondary inflation consequences of a weakening loonie? I think that that's important to put on the public stage. It's important to put in front of central bankers.
All right, we're going to end it there, Stuart. Thanks very much for joining us. We're going to go join the news conference.
Thank you.
In progress, but thanks very much. Stuart Paul, U.S. and Canada economist at Bloomberg Economics. And let's head to the Bank of Canada news conference.
From elevated levels. And third, uncertainty remains high. The conflict in the Middle East has re-escalated in recent days, and trade discussions with the United States remain ongoing. Aujourd'hui, le Conseil de direction a maintenu le taux directeur à 2,25%. Nous avons trois messages clés. Premièrement, après un an sans progresser, la croissance économique semble...
First of all, after 1 year without progressing, the economic growth seems to be going back again in Canada. We're facing, strong wind, but the companies are adapting themselves. Secondly, the inflation in Canada should start to reduce gradually as the prices of oil, worldwide will go down. And thirdly, the uncertainty remain high. Tensions in the Middle East, negotiation with the United States are still going on.
So let me now expand on the outlook, the risks, and the implications for monetary policy. Growth has been dented by the conflict, and global growth has been dented by the conflict in the Middle East. But with oil prices coming partway back down, growth is expected to recover. Equity markets have been buoyant, and credit spreads remain compressed. Canada's GDP growth was flat over the past year as the economy adjusted to new tariffs, elevated uncertainty, and slower population growth. The economy remains in excess supply. The labor market has been soft, with the unemployment rate hovering in a range of 6.5% to 7%. GDP growth in the second quarter is estimated to have picked up to 2.5%. While this rebound from the first quarter largely reflects the unwinding of temporary factors, sources of economic growth appear to be broadening. Recent indicators point to continued solid consumer spending. Housing activity, which has been weak, looks to be stabilizing. Export growth has resumed and is expected to continue to strengthen, albeit along a lower path. Business investment is picking up, boosted in the near term by the oil and gas sector. And although the Canada-US-Mexico agreement is now subject to annual reviews, more businesses report they are finding ways to navigate through this uncertainty. Government spending also contributes to higher economic activity over the projection. Overall, our growth outlook is similar to our April forecast, but the data we've received since April have increased our confidence that the economy is indeed working through this period of global upheaval. Following GDP growth of 0.7% in 2026, the economy is projected to grow by 1.8% in both 2027 and 2028. As the recovery proceeds, economic slack will be gradually absorbed. CPI inflation rose to 3.2% in May, mainly because of the higher gasoline prices linked to the conflict in the Middle East. Excluding gasoline, inflation was 2.2%, and measures of core inflation have remained close to 2%. So far, we're not seeing broad spillovers of energy prices to other goods and services. Near-term inflation expectations are sensitive to changes in gasoline prices, but longer-term inflation expectations remain well anchored. War-related cost pressures are still working their way through some consumer prices, but they're being offset by downward pressure from other prices from continued economic slack. In addition, the recent depreciation of the Canadian dollar will make our exports more competitive, but it also increases the costs of our imports. Inflation is expected to stay elevated in June and then ease gradually in the coming months, returning to the 2% target in early 2027. I do want to underline that this forecast is highly dependent on the path for global oil prices and gasoline prices. It assumes oil prices come down and stabilize between $70 to $75 US per barrel. Since finalizing our forecast on Friday, the futures curve for oil prices has already moved higher. We've been looking through the direct effects of higher oil prices on inflation, but the longer they remain elevated, the bigger the risk they spill over to other goods and services. As we've said before, we will not let higher oil prices become persistent inflation. The two biggest risks to the projection are still the conflict in the Middle East and our trade relationship with the United States. There are also domestic risks to our inflation outlook. As inflation comes down, there's a risk that it gets stuck above the 2% target. If cost increases and their pass-through are larger than expected, or the economy recovers faster than expected, inflationary pressures will increase. On the other hand, there's a risk that the second quarter pickup in growth is not sustained. The recovery in exports could stall, which would likely weigh on business investment and hiring. A weaker economy would mean more downward pressure on inflation. S'appuyant sur la projection du rapport d'aujourd'hui,
the projection of the report of today, the board of directors says that the rate, is still appropriate to the economic growth and to economic recovery, but the uncertainty remains very high. The board of directors will keep on monitoring the Canadian economy and the perspective of inflation, and we are ready to adjust our policies if necessary. The bank, to preserve the confidence of all Canadians and the stability in prices in all that uncertainty period.
Based on the NPR projection published today, Governing Council judges the current policy rate remains appropriate to sustain the economic recovery and bring inflation back to the 2% target. However, uncertainty is still high. Governing Council will continue to assess the strength of the Canadian economy and the outlook for inflation, and is prepared to adjust monetary policy as needed. The bank is committed to maintaining Canadians' confidence in price stability through this period of global upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now. We, as usual, have a good number of people joining us, so I'm going to ask everyone to limit yourself to one question so that every media outlet has the chance to participate. And I'll just remind people to come off mute only to ask your question, then go back on mute as soon as you've finished. That way, everyone's going to be able to hear the question and the response. Et comme d'habitude, libre à vous de poser vos questions dans la langue officielle de votre choix. So I'm going to call first on Craig Lord from Canadian Press, followed by Mark Rendell of the Globe and Mail and Pramit Mukherjee from Thomson Reuters. So Craig, please go ahead.
Good morning, governors. Thank you for taking our questions. One of the things you mentioned in your opening statement is that since the April MPR, you have growing confidence that the economy is working its way through these headwinds. What is giving you that confidence right now?
Since our last report in April, there have been quite a number of economic indicators, and certainly what they're suggesting is that the economy is now expanding, and the signs as that data have come in have become clearer. For the second quarter, we're estimating growth of about 2.5%. So where is that coming from? Well, a few sources. First of all, we've seen continued resilience on behalf of Canadian households, consumers. Consumer spending has remained pretty solid through this. The housing market had been weak. It had actually been contracting. It looks like it's stabilizing, so it's probably not going to add a lot to growth, but it's not going to be subtracting from growth. I think where we're seeing a bit more momentum is in exports. Exports, as you know, have adjusted to U.S. tariffs, and they now look to be growing again. Yes, they're growing along a lower path than what they were on, but they are getting back to growth. I mean, when we talk to businesses, what we're hearing is they're adapting to this uncertainty. The other thing is that the U.S. economy is strong. That is creating strong foreign demand for our exports. U.S. orders, they are starting to come back. Businesses are, there's some, in some cases like aluminum, businesses are finding new markets in Europe, for example. So we're seeing a certain adaptation, and with more strength in exports, we think there'll be a pickup in business investment. Certainly, we expect to see some boost in the near term in business investment coming out of the oil and gas sector. High oil prices are encouraging more investment in oil and gas. So, you put those things together. The second quarter is looking. We already have a fair amount of data for the second quarter. That's looking pretty solid. I think the thing that we're going to be assessing going forward is how sustainable is that pickup. We think when we talk to companies, when we look at the sort of change in momentum, we do think it is sustainable. But yes, there is a risk. Growth, particularly exports, could stall going forward. If exports stall, I think investment will stall, hiring will slow down. So there are some risks, but increasingly the economy is looking like it is in expansion.
All right, next we're going to go to Mark from the Globe and Mail. Go ahead, please, Mark.
Thank you for taking the question, Governor. In your statement, you removed the reference to potential consecutive hikes if oil prices feed through into inflation. What was the decision to remove that reference? And if oil prices do once again rise, are you expecting to need consecutive rate hikes to keep inflation under control?
The short answer to that question is yes. But let me emphasize a couple things. If you go back to our April report, we outlined a scenario where oil prices were high and they stayed high. And what we indicated is in that scenario, if that happens, the likelihood that higher oil prices start to pass through to prices of other goods and services, inflation becomes more generalized and starts to become more persistent. And we indicated in that scenario, yes, we would likely need at least consecutive hikes in interest rates to get inflation back to our target. So where are we today? Well, today oil prices are lower than their peaks in April. Obviously, in the last week, you've seen them back up considerably. They're about halfway back to where they were. And look, I mean, let's be frank. The situation in the Middle East remains very volatile. It looks like it's a long way from being resolved. And so, yes, if oil prices go higher and they remain higher, there may well still be a need for consecutive hikes. I do want to stress, though, that that's not our base case. It wasn't our base case in April. It's not our base case now. Our base case now is that oil prices will gradually ease. Inflation in Canada will also gradually ease. But it is a risk. And then the last thing I would just underline is it's not the only risk. For example, in my response to the previous question, we are more encouraged that growth is picking up. But there are questions about how sustainable that pickup is. And if that, if exports stall, if investment weakens again, if housing slows, there'll be more excess supply in the economy, more downward pressure on inflation. So there are risks on both sides. And, where we landed today is that at this moment, our best judgment is where we are now looks appropriate. But we underlined uncertainty is high, and we're prepared to adjust monetary policy as needed.
Okay, next up is Pramit. Go ahead, please.
Hi, Governor. The bank now says that the growth has resumed and is broadening, while headline inflation is above 3%, but is easing. Now, how has the balance of risks shifted since April? And as a result of that, where is the bar for a cut and a hike?
Well, you described our outlook pretty well. I'm not sure how much more I can add, really. Look, I'm not going to give you, I'm not going to handicap the next decision. We're going to take our decisions one at a time. I think what I would emphasize there is monetary policy has been facing this dilemma, as you suggested. Inflation is high. It's above our target. It's actually a little bit outside the 1 to 3 band. Growth's been weak. The economy hasn't really shrunk over the last year, but it hasn't grown either. And there's considerable excess supply in the economy, which means there's room for the economy to grow without creating inflationary pressures. The thing is, you can't at the same time raise rates to lower inflation and lower rates to raise growth. So there's a dilemma. What we're seeing relative to where we were is that, if this forecast plays out, that dilemma will be resolving itself. As you said, growth will be picking up, inflation will be coming down, and in that sense, yes, it's a fairly positive outlook. There are risks around that outlook, which I've already talked about. The reality is that the world's an uncertain place, and there's always some uncertainty about just how events will play through, how they will affect the Canadian economy, how quickly it's adapting, how quickly higher costs will get passed through. We'll be watching all those things, and as we've indicated, we're prepared to respond as needed.
Okay, in the next round, I'm going to call first on Paul Vieira from the Wall Street Journal, followed by Najoud Almaliz of Bloomberg and Greg Quinn from Market News. So, Paul, please go ahead.
Good morning, Governor. Your opening statement talked about the role the Canadian dollar's weakness is playing in terms of aiding exports, but you also said that it could increase the cost of imports. How much is the value of the Canadian dollar, or conversely, the strength in the U.S. dollar? How much is that playing? How big a role is it playing in your rate policy decisions?
Well, the short answer, Paul, is it's not been a major factor. The Canadian dollar has depreciated about a couple of cents since the last decision. We, as you know, we don't target the Canadian dollar. Flexible exchange rate's an essential part of our monetary policy framework. It allows us to set interest rates in Canada for the needs of the Canadian economy. I think, as we mentioned in the report, you've seen some widening in yield, government bond yields between Canada and the United States. I think that's weighed a bit on the Canadian dollar. As we highlighted in the report, a weaker Canadian dollar does make our exports a little more competitive. At the same time, it does increase the costs of imports into Canada. We don't forecast the Canadian dollar. We've assumed a 71-cent dollar going forward in our forecast. So, that effect is about, 2 cents is a pretty small effect in our forecast. The boost to inflation would be pretty small, and the impact on exports would be pretty small. It's not a major consideration in the forecast. But yes, it is embedded in the forecast.
All right. Next, we'll go to Najoud Almaliz. Najoud?
Hi, Governor. I wanted to ask you about the recent string of major project announcements, particularly related to a pipeline in Alberta. I'm wondering if these announcements are changing your view on the medium-term growth outlook, and does the bank see any evidence of these announcements affecting business confidence?
Go ahead.
Well, these are major projects that are in. I would characterize them as in the development stage. So they don't show up. It'll take a long time before they show up in the hard economic data. Your question about confidence. It would be hard to discern any one project's effect on confidence measures from the survey data that we track. But I think what you could say is that the move up in optimism that we have in this outlook is affected overall by confidence, and I think it would be reasonable to think that one of the things contributing to that is some of these larger project announcements.
Okay, next on the list is Greg Quinn from Market News. Go ahead, please, Greg.
Good morning. Governor, the report mentions the risk of inflation broadening kind of maybe escalates the longer the Iran conflict goes on. But, that conflict has been going on since the end of February, and there's been lots of ceasefires and not ceasefires. Hasn't enough time passed by now to have more serious concerns about a flare-up in inflation?
Well, you're certainly right that the war is ongoing, and I certainly cannot predict when it might get resolved. So there are certainly some risks there. With respect to what's happened since the war started about 4.5 months ago, oil prices initially went up very sharply. They peaked in April, a little over $120 a barrel. They actually then came down quite a bit to about $75 US. Obviously, you've seen in the last week they've gone back up closer to around $85. So they backed up quite a bit, although they're still a lot lower than they are in April. And yes, the longer oil prices stay high, the bigger is the risk that begins to spill over into the prices of other goods and services, and inflation starts to broaden. It becomes more generalized, and that would certainly be a signal, a warning sign to us. The sort of the progression is it right now. What you see in the data is that inflation is very concentrated in gasoline. The cause of inflation is very concentrated in gasoline prices. Headline CPI inflation, the latest reading is 3.2%. CPI ex gasoline is only 2.2%, and our measures of core, trim, and median are very close to 2%. So far, it's very concentrated in gasoline prices. We will be assessing very closely the spreading. We expect to see some pass-through of higher oil prices to other prices, and we built that into our projection. I think in the monetary policy report, we indicate the peak effect is about 0.4 on CPI inflation. In the projection, though, that is being somewhat offset by the fact that the economy is in excess supply. That's putting some downward pressure on prices. So inflation, provided oil prices do come down, eases in Canada. There are risks. Clearly, if oil prices go higher, they stay higher, the likelihood that gets passed on, it broadens, increases. And, there's a progression from broadening to persistence. And yes, if that happens, we may well need to raise interest rates. That's not our base case, but it is a serious risk.
Okay, we've got a couple more rounds to go. Next, I'm going to call on Mackenzie Gray from Global News, followed by Judy Trin of CTV. So, Mackenzie, over to you.
Hi there. In the NPR today, there's 2 references to unsold condos in Vancouver and Toronto. I'm wondering if you can evaluate the risk associated with that and offer any comment you may have on the impact that the government's plans to buy some of those condos in BC could have on those risks that you've outlined.
Well, I think the condo market, both in British Columbia and in Toronto, is going through a pretty material correction. It's sort of the accumulation of the effects of a big decline in an investor market, change in population growth. That's left behind a bit of an overhang, both in the type of inventory and the price of inventory. It's going to take a while for that to clear out. This is something we watch. It doesn't have a big effect on our monetary policy decisions. It has an overall effect on housing. The governor talked about what we see in the overall housing market. From a financial stability perspective, a correction in one segment of the economy and one segment of the housing market is not a direct threat to financial stability. It has to be quite a bit broader and more persistent for that to spill over into a financial stability risk. The programs that you mentioned, I think the details are still coming out about these programs. It may help sort of ease this material correction that's going on, but that's about the only comment we could make on that.
Okay, and next going to Judy from CTV News.
Hello. is it possible that you are being overly optimistic? I'm hearing so many caveats in your comments as to the state of the economy. At the same time, your business survey that you put out just a few days ago indicated that business sentiment has deteriorated over the past 3 quarters. Or has deteriorated after improving over the past 3 quarters. So I'd like to get a better sense of the reality. You show. I'm sorry, I'm having problems expressing myself because the data seems conflicting at many points. So what I'm trying to get at is, do you really think that the economy is going to improve this year? And over the next few years, given the constraints that we are feeling and facing right now?
Well, we're calling it as we see it. So yes, our baseline forecast is that the economy is going to improve. There are risks around that, as I've talked about. But to come back to why are we feeling more confident that the economy is expanding once again? Going back to some of the data I outlined at the outset, consumers, you got to give some credit to Canadian consumers. They've been resilient. They are consumer spending is still expanding. It's not a big number. There's very little population growth in the Canadian economy at the moment, so there's not new consumers entering the economy. But Canadian households are still spending. That is supporting growth. Where we've seen weakness, we've seen weakness in the housing market. As I said, we don't expect the housing market to be a big boost to growth going forward, but what we are seeing in the housing market is, after a period of decline, it is stabilizing, so it's not going to be subtracting from growth if that holds. Where we see a little more momentum than we have seen is in exports. Canadian businesses have been adapting to a more difficult trade relationship with the United States. That includes severe tariffs on a number of key sectors in the Canadian economy. It's also created an environment where there's more trade uncertainty. We're a good year into that now. What we're hearing from companies is they are adapting. They're finding ways to work with their clients. They're reconfiguring their supply chains. They're getting on with business. And the other factor is the U.S. economy is strong. I mean, the reality is they need our exports. And you're seeing U.S. businesses increasingly, increase their orders for our Canadian exports. And if you get more exports, with that, you'll probably get more business investment. We're already seeing plans in the oil and gas sector for more investment. Obviously, when oil prices are high, the value of our oil exports is higher. Companies are incentive to increase output, and so they're investing. So, when you look at the data we have, when you look at our business surveys, you're right that the overall index isn't very optimistic. But if you look at the subcomponents, you look at what companies are telling you about their plans, you can see more optimism going forward. So that is built into our baseline. And that is our best assessment of the growth path for the Canadian economy. Absolutely, there are risks around that. There could be new developments that momentum we see could stall. That is something we're watching very closely. We want to see this pick up and grow sustained. The economy's in excess supply. It's got room to grow without causing inflation. We want to see that excess supply absorbed. That's going to be important to getting inflation back to target and keeping it there. So that's something we're going to be watching closely.
Okay, we'll go into the final group now. I'm going to start with Anna Pereira of the Toronto Star, followed by Rob McClister from Mortgage Logic News, and we'll conclude with Max Sato of Mace News. So Anna, please go ahead.
Hi, good morning. So I know that this is not your base case, but I'm hoping you can give an estimate of how high oil prices need to get and for how long until they need to stay there until the impact on inflation does become broad-based.
Well, I'm afraid you're going to be disappointed because I'm not going to put a number on those things. The value of publishing scenarios like we did in the April monetary policy report is they give you a sense of without putting a precise number on it, they give you a sense of when it really becomes material. So if you go back and you look at that scenario, I can tell you that what's really key is it's not only how high it goes. The key thing is how long it remains high. If it goes up and comes down, inflation's going to go up and come down. And so, that's probably not something we'd want to respond to, because if we raise rates, by the time rates feed through to the economy, inflation's already going to be down, and we're going to regret that we raised them. We didn't need to. What's really key is the persistence. If oil prices are higher and they remain high, then that really increases the persistence of inflation. It increases the spreading of higher oil prices to the prices of other goods and services, we've been very clear that we're not going to let higher oil prices become generalized, persistent inflation. So that is something we'd need to react to. What I can also tell you is we will be watching closely. We're going to be watching oil developments in oil markets very closely. We're also going to be watching very closely how much those spill over to other goods and services, because how much it spills over also depends on the state of the economy. If the economy is weak, if it's got excess supply, companies they're more reluctant to raise prices. They find it very difficult to raise prices. They don't have enough customers already. If they raise prices, they're going to lose more customers. They may decide to absorb more of that. So that's why I can't give you a simple answer with a simple number. It's going to depend on the state of the economy. It's going to depend as much of the persistence is on how high. But that scenario we published in the April monetary policy report does give you a clear indication.
Okay, next, Rob McClister, please go ahead.
Good morning. Housing has barely responded to a 275 basis point cut in the policy rate, and that's despite a purported housing supply shortage. Do you sense that monetary policy might have lost some traction on housing, and how much could that potentially hold you back from tightening rates in the future, other things equal?
Well, I think there's a number of things affecting housing right now, Rob, as you would know. Monetary policy is one of them, but we have an affordability problem with housing in the country. So I think that's affecting, dampening the effects that a rate decrease might otherwise have. We also have this overhang of uncertainty. Housing is probably the biggest purchase most people will make, and if you're in a period of uncertainty, your inclination to make that purchase is less. So I think those are things in the mix that are probably holding the housing market back from what would otherwise be a response to monetary policy.
Okay, and finally, Max Sato from Ace News, please go ahead.
Thank you, Ned. It's been my pleasure working with you. Good morning, Governor. My question is about the monetary policy framework. It seems that the 2% inflation target will be unchanged, but in your report on consultations with Canadians released last month, I didn't see a direct reference to the policy decision process in the summary. And while other major central banks have adopted a voting system, can you tell us again why your current process of consensus building works better for Canada, especially from the context of operating in the age of high uncertainty?
Yes. Well, as part of the monetary policy framework review, we're not reconsidering our consensus-based system. Look, we think the consensus-based system works very well. And actually, since we're both part of it, I'm gonna say a few things and ask Senior Deputy Governor to join and give her perspective. But I guess I'd underline a few things. First of all, in the composition of the Governing Council, we do look for diversity of background, diversity of experiences. In recent years, we've added 2 external deputy governors to provide more diversity, to provide additional perspective. What I like about the consensus-based system is that it forces you to really listen to your colleagues. We deliberate. We need to come to a consensus. We need to put our heads together to come to the best collective judgment as what's the best interest rate, what is the best policy decision for Canada. And the consensus-based system, it encourages some back and forth because, I need to try to convince them. They need to try to convince me. I need to listen to their points. They need to listen to mine. And through that process, we come to, I think, a better decision than any one of us would come to individually. We do publish a summary of our deliberations that outlines the options that were on the table. It outlines sort of what the thinking was on the range of thinking was on different issues, and it provides some indication as to how we came to a consensus. So, and I think that the value of that is it gives people a little more insight into what's going on underneath the hood, and I think over time it helps markets understand our reaction function. But you live through this every time I do, so why don't you give your perspective?
Well, Max, I would agree with everything the governor's described. I think we make better decisions in our consensus-based system. I also think the strength is that we communicate with one voice. Getting to our decision requires a consensus, and we also work hard at communicating it in consensus. And so what that means is folks like you have it's easier for you to interpret the decision. You hear only one voice. You're not spending your time trying to parse different messages or determine who agrees with who or who might have dissented or voted differently or anything like that. I think both the decision itself is better and our ability to communicate clearly is better.
And that will conclude today's press conference. So thank you, Governor. Thank you, Senior Deputy Governor. Thanks to everyone for joining us.
Thank you all, and I hope you get a good summer.
Yeah, happy summer.
All right, summer officially starts now. That was Tiff Macklem, the Governor of the Bank of Canada, and Carolyn Rogers, the Deputy Governor. Just some of the highlights. The Bank of Canada holding its overnight policy at 2.25%. No real surprise there. All the analysts pretty much had that picked at it. Some of the impact here, the bank held the overnight rate. Current policy described it as appropriate to sustain recovery. And the bank dropped its reference to consecutive rate hikes in its statement, a notable dovish shift there. Some of the quotes: after a year of weakness, Canada's economy is showing signs of improvement, with sources of growth appearing to broaden and recent indicators pointing to continued solid consumer spending. Now, the bank did revise its 2026 GDP forecast to 0.7 from 1.2, citing the Q1 downside surprise in the sustained trade war with the U.S., but growth for 27 and 28 was revised upward to 1.8% for both of those years, and the labor market described as soft. Bank now sees CPI inflation at 2.5%, up from its prior estimate of 2.3%. And war-related cost pressures are still working into prices, is what the governor had to say. And they were characterized, as we mentioned, as more dovish. Some of the questions on it: rate hikes and higher oil prices. Could that prompt the bank to raise rates? Macklem acknowledged that higher oil prices could prompt rate hikes, but stressed this is not the base case. And the bank's view, when asked about the bank's view on the U.S. economic backdrop, Macklem noted the U.S. economy is strong and needs Canadian exports, a constructive signal for Canada's trade outlook. One other note: somebody asked about the infrastructure projects, economic sentiment, the impact they might have. Senior Deputy Governor Carolyn Rogers said it would take too long. It would take a long time before proposed major infrastructure projects show up in hard economic data, but noted they may be helping overall sentiment. And so there was where we sit right now with the BOC. So let's take a look Let's take a look now at some of the headlines, things making news right now that we're tracking for you in the BNN Bloomberg newsroom. And the Bank of Canada holding interest rates steady at 2.25%. Governor Tiff Macklem says Canada's economy is showing signs of improvement, but warns that uncertainty is still high as it works through global upheaval. The central bank has also dropped any reference to consecutive hikes and now warns there may be a need to cut if the U.S. imposes major new trade restrictions. The BOC also sees growth rising by 2.5% in the second quarter and boosted its outlook for 27 and 28. Canadian home sales rose slightly for the third straight month in June. The number of sales increased by about a half point, building slightly on the previous 2 months. The Canadian Real Estate Association now expects a decline in yearly sales over 2025 and has lowered its guidance for the year. However, the group says the slight gains over the past 3 months suggest that a recovery in the market is taking place. Canadian wholesale sales, excluding petroleum, oilseeds, and grain, remained essentially unchanged for the month of May, according to Stats Canada. Sales were sitting at about $90 billion for the month after seeing an increase of 1.4% in April. The largest decreases came from the food, beverage, and tobacco subsectors, as well as personal and home goods. All right, quick look at the markets. The TSX still up for the day, still well above 35,000, not far from record highs, but it's only up by about 0.14%. And south of the border, still holding on for the rally there, but they've slipped a little bit. The S&P 500 up by about 0.16 and the NASDAQ by about 0.28. All right, as expected, the Bank of Canada held its policy rate steady today as the central bank balances a weak economy with inflation heating up. This decision marks the central bank's sixth consecutive hold. Joining us now is Pippin Rai, the head of ETF strategy at BMO Global Asset Management. Pippin, thank you very much for joining us.
Thank you for having me.
Okay, what stands out from for you from what we heard from the bank?
Yeah, it was a couple of things. I mean, it's certainly more optimistic of a statement, and also comments from Bank Canada Governor Macklem, as well as Senior Deputy Governor Rogers, on the outlook for the economy on a go-forward basis. I mean, certainly you could quibble that outlook for growth this year, or at least GDP, has been revised lower, and that should still indicate some degree of slack in the economy, or at least a build in slack. But at the very least, I mean, this was more of an optimistic tone that the bank struck today with respect to real activity on a go-forward basis. When it comes to inflation, I mean, certainly, there are signs that inflation is moving back towards a 2% level. I mean, the core measures seem to be aligned with that. And also we look at inflation expectations, both short-term and longer-term, there aren't really signs of concern there. So on the whole, if you take everything on the aggregate, I mean, a more cautious, or at least a more optimistic outlook, I would say, on the economy, and really a bank that can afford to be inertial at this point, and really wait to see how the external developments outside of Canada continue to play out, and whether or not we're seeing some endogenous improvements as well.
And do you agree on some of the comments that it's more dovish, this approach?
I suppose. I mean, there's so many comments made and so many caveats as well that certainly you could talk me into a dovish statement for sure. But that doesn't necessarily mean that the bank is on the verge of rate cuts or anything of that ilk. I mean, certainly, this is a bank that, again, can afford to wait things out and see how the domestic data plays out. Certainly by revising the GDP lower for this year. I mean, it's setting a lower bar to exceed expectations. And in our minds, I mean, if you're asking us to pinpoint what the next move from the Bank of Canada is going to be, we still think it's going to be a hike, albeit not in 2026, probably more likely at some point in early to mid 2027.
All right. And how much of a factor is energy with everything going on, with what's unfolding in the Middle East? What role is that playing?
Oh, it's an important factor, for sure. I mean, you could look at it as an energy exporter in two different ways for Canada. I mean, certainly it should lead to a rise in national incomes, given the fact that we are a net energy exporter to the rest of the world. But at the same time, I mean, it does matter for us as gas consumers and energy consumers as well, right? And this is happening at a time when, again, there's a fair bit of slack in the economy, and households are becoming more judicious about how they allocate their spending. And certainly, thankfully, at this point, we're seeing a little bit more stability insofar as the employment backdrop is concerned. So at this point, it does feel like, given the fact that energy prices have moved lower over the past month or so, I mean, there is this sense of relief amongst households that they could spend a little bit more. And certainly we've been seeing that reflected in the data. But, if we're talking about energy prices as a whole, they do matter as an input for the Bank of Canada's calibration process. If we're talking rate hikes, I mean, we heard it again from Macklem today. If energy prices remain elevated, then the bank, could be looking at rate hikes a little bit sooner than expected.
Okay, and CUSMA, what factor is that? I mean, we seem to be moving along with it. We're kind of baking it in now. Where we're sitting, but a deal. What kind of an impact would a deal have?
I mean, insofar as uncertainty is concerned for Canadian businesses that are looking to invest and hire over the medium to long term, it's huge. I mean, given the fact that the United States is our most significant trade partner, so many jobs in the Canadian economy depend on trade with the United States. So it's a huge factor to pay attention to. And if we're in an environment where we're looking at annual reviews, I mean, certainly, you can make the case that Canadian businesses are growing a little bit more comfortable with investing in that backdrop, but it's not the same as, the environment that we had before last year or even this year. And so, for me, if there is some sort of accord with respect to the United States insofar as CUSMA is concerned, if there's a long-term arrangement, whatever shape that takes, you'll see more spending when it comes to investing and hiring plans as well, increase on the part of Canadian businesses. And that's good news for the Canadian growth backdrop. And it also tells us at the margin that inflation risks could tilt a little bit more towards the upside and get the Bank of Canada looking at rate hikes a little bit sooner than expected.
All right, and with job, we saw 18,000 jobs added in June. A lot of that was part-time work. What does that tell us about the economy right now? I mean, he revised, but what does that tell us when we see part-time jobs only most of those created?
Absolutely. I mean, if we're talking about the employment backdrop, the fact that it was primarily part-time jobs, and if I recall correctly, it was in rec-related activities. I mean, that should be a hint that this was primarily driven by FIFA, the World Cup, and other related events. That tells us that this is still a very fragile backdrop for the labor sector. And this is, to the Bank of Canada's credit, it understands that, given this backdrop, it's probably best to proceed on a cautious basis as opposed to really giving definitive guidance as to what the next move is going to be. So again, take the stock of data, allow it to tell us how the sort of winds are shifting with respect to the labor backdrop and with respect to real activity. And then once that becomes a little bit more clear and the direction of travel is becoming more and more clear, then the next move, in our view, is still very much a rate hike from the Bank of Canada.
And then the Fed south of the border, it's leaning towards possible rate hikes at some point. Does that put pressure on the bank to follow suit, or can they keep it separate?
Not necessarily. I mean, this is one of the misconceptions that we feel that comes up from time to time, that the Bank of Canada is explicitly just a spread central bank insofar as what the Federal Reserve does, the Bank of Canada has to shadow. That's not necessarily the case. And it's especially not the case if there is this fracture in trade relations between the two countries. And what that means implicitly is that the Bank of Canada might need to keep rates a little bit more accommodative, or at least a little bit at a lower nominal policy level relative to the United States for that reason. And that could introduce some degree of volatility in the exchange rate, and certainly it has over the past couple of months. And we do sense that the market has picked up on that. But at the very least, I mean, if the Federal Reserve is looking to raise rates for this year and even into early 2027, there could be some pressure on the Bank of Canada via inflation through the exchange rate channel, but we don't think it's going to be as acute of a risk.
And one last question: is the dollar going to play a role in any of the decisions, or is it along for the ride?
The Bank of Canada uses the exchange rate as an input into its decision-making, not necessarily something that it wants to control, and rightfully so. I mean, the exchange rate should be determined by market-related conditions. But, if we do see a fairly substantial weakening in the Canadian dollar that does pass through to inflation, then the Bank of Canada will take that into consideration. But again, it would take a substantive move with respect to the exchange rate for something like that to happen. So we don't see it as an acute risk anytime soon.
Okay, Bipin, we'll wrap it up there. Thanks, as always, for joining us.
Thank you so very much.
Bipin Rai, head of ETF strategy at BMO Global Asset Management. Coming up, sales of electric vehicles soared in May, up nearly 20%. We'll break down the numbers after the break.